Hello and welcome to Livewire's Alternatives in Focus series. I'm Sarah Allen and today I'm joined by Lonsec's Chief Investment Officer, Nathan Lim. We're going to take a look at how investors can use alternatives in their portfolios. Thank you for joining me today, Nathan.
Great to be here, Sarah.
So to begin with, what role do alternatives play in portfolio construction?
At Lonsec, we like to look at alternatives in a slightly different way. And what we mean by that is that alternatives, as I think my colleague spoke to it earlier, is a very broad church. And so we actually allocate alternatives to both the defensive and also the growth side of our portfolio.
What are you cautious about with this asset class?
The biggest concern that we have with this asset class right now is the disconnect that we're seeing between listed and unlisted asset valuations. Again, looking at the work that's coming out of Lonsec research, when you look at the value of REITs since the start of COVID till now, listed assets are trading at about a 25% discount to unlisted assets. And we think that seems a bit odd to us. And what we're concerned with the unlisted space is that perhaps this is setting up a period of persistent underperformance in the coming years for this asset class. Anecdotally, when we speak to some of our managers that we engage with, especially around the infrastructure space, they're also observing this big disconnect between listed and unlisted valuations.
Okay, that's concerning. So when it comes to sizing, there's a lot of different theories about what the optimal allocation for alternatives is in a portfolio. What do you recommend is the right spectrum for sizing in portfolio construction?
When it comes to our portfolios at Lonsec, we actually allocate alts right through the whole spectrum, all the way from, at one bookend, our conservative, all the way through to our growth allocation. So I've got some numbers here just to put these into context. Within our defensive allocation, we'll have around a 12% allocation to alternatives. For growth, it's around 19, and for balance, it's around 17. But within those allocations themselves, we then will allocate or sub-allocate between defensive and growth allocations. So going back to those bookends, at the growth end, it will be 100% growth alternatives, whereas at the defensive end, it'll only be about 17% of that allocation will be in growth alternatives.
Okay, and do you shift that depending on the market?
Yeah, that's right. And so we will take advantage of market conditions to either dial up or dial down the mix of defensive and growth alts, depending on market conditions, definitely.
And what are you seeing at the moment?
So what are we seeing right now is that we definitely have a preference for multi-strat hedge funds. These are a type of hedge fund that utilize a multitude of different investment strategies to try to generate a positive return. And so what we're talking about here is that they will go into equities, bonds, currencies, volatility markets. They may actually take an absolute position or they may take a relative position. Basically, they've got the freedom to go where they seem to find alpha. What we like about these strategies over this current point in the cycle is that they've really provided us good, steady returns in the portfolio. Said another way, what they've been able to do for us is zig when the market zags, right? That they are able to provide us another form of diversification, but at the same time providing us positive returns, which really helps drive a better Sharpe ratio in our portfolios. I just want to touch on that point with Sharpe ratios. I think it's very important for investors to remember that you need to actually use risk in your portfolio, and the Sharpe ratio is actually a very good indicator of manager skill. What alts do is that by helping you smooth out your volatility, you actually can use alts to enhance your risk-adjusted returns in your portfolio. And this often comes through a high Sharpe ratio.
And what managers do you prefer in this space?
Like I said earlier, we definitely have a preference for multi-strat strategies right now. When we reflect on some of the best managers in the market who have some interesting options, two names come to mind, Fulcrum and Janus Henderson. I would also add that another alt that is also very attractive to us right now is gold. Especially during these troubled times, gold has acted as a great diversifier to help get a different source of alpha generation in the portfolio.
Okay, and you use gold in your portfolios at the moment?
Yes, we do.
Okay. Well, thank you very much for sharing those insights, Nathan. Much appreciated. And if you enjoyed listening to this interview, please subscribe to Livewire Markets and Market Index. Thank you for watching.